CFDs are contracts for difference. I just found out about these things, but it makes sense because they're technically banned in the US. They are available though in Australia, Canada, the EU, Hong Kong, Israel, Japan, New Zealand, Singapore, South Africa, Switzerland, and the UK. So pretty much everywhere but the US. And it's a shame because they sound like risky vehicles, but in reality, they're not that complex or that risky. I've just done a deep dive, an absolute deep dive. It's daytime right now because I thought it was going to be difficult to understand. But the fact of the matter is it's not. So if you are in one of those countries or you're outside of the US or you happen to move somewhere or you're traveling or whatever, regardless, hypothetically, what you could do if you were in the US and say you're moving around or is something you could consider. I'm not saying I'd do it, but it's something you could consider is you get set up with the NordVPN and then eToro is like the CFD hub. But that's what I've realized. When you trade CFDs, you go to eToro. Now with CFD contracts, you don't own anything at all. With options, you own like the right to buy or the right to own those shares. With CFDs, you actually don't own anything. It's essentially a contract where you're speculating on the direction of the stock price or what have you. You can get a CFP on literally anything. The NASDAQ, the S&P 500, individual stocks, commodities, futures, currency pairs, cryptocurrency, whatever. And essentially what the contract is, now remember, it's the contract for difference. And what that difference refers to is a spread. Your entry is also everything. They're insanely leveraged. There's no strike price. There's no expiration date. There's no commissions. So, I mean, in all reality, they can be lucrative. But for one reason or another, it's become a gray market for retail investors. I guess some brokers do. Some brokers can. It's kind of up in the air. And all the legislation I could find out there points to retail investors. They always say retail investors. What? Are they allowing hedgies to? Doesn't make sense. It just kind of seems like they're boxing us in there and they don't think we're capable of managing risk. I don't know why there's the sort of restrictions that there are on CFDs. I mean, a year and a half ago, we were allowed to trade stocks like crypto stocks, imitation stocks on the FTX website. You could just buy like a Tesla coin and it was supposedly backed by something. So we can't trade CFDs as retail traders. The regulation is overall spotty. In 2012, there was an act that mentioned it and there was kind of like a gray area until 2021 where the SEC kind of stepped in and made a more official ban, but it still seems to be at the discretion of the broker, to be honest. There's nothing rock solid out there in terms of legislation. They're really not that risky at heart, especially without an expiration date. Taking time decay off the table alone limits risk. Just think about it. Without time decay, if you get that entry right, I mean, you can start printing almost immediately. The leverage that some of these brokers offer is nuts though. They go up to like 500 to 1 ratio. But for this example, we're just going to use $100 as the asset price, the entry price. And then your deposit is $100, but you're leveraging $1,000 because it's 10 to 1. You buy one going long at $100. So then you're in long with $1,000 on the line. If the stock goes up to $110, that's $10 per 100 shares. That's $1,000. Same thing, if it goes down from $100 to $90 and you were long, that's $10 times 100 shares, you lose $1,000. So that $100 entry is literally your break even, because if the stock goes up, you're making money. If it goes down, you're losing money, and vice versa. If you have a short contract and it goes down, you're making money, and if it goes up, you're losing money. And the way margin calls work is a little different. You're more likely to get liquidated, but as long as your account has that value, you're fine, and you'll only get a maintenance margin. And that's a heads up that you need to either deposit money or get out of the position and, pay up. The maintenance margin will come before the actual margin call. And maintenance margin is essentially just a warning. It's essentially the same thing as having options contracts and risking expiration and assignment and not having the capital in your account. They'll sell the contract for you in that case, but here you'll have a maintenance margin call. So it's a heads up to get money back in the account or else. What I'm really interested in is testing out some new strategies, like cross-pollinating Iron Condor, I think having a position in the same play using both those strategies could be lucrative. Because with an Iron Condor, you're betting on just minimal barcoding, minimal movement in either direction, flat. And if all goes well, take profit from both sets of contracts. So I think having a position in the same play using both those strategies could be lucrative. Because all in all, having multiple strategies in your back pocket is what enables you to be a well-versed trader. Proceed with caution, enjoy some green on the screen, and to the moon. Don't forget to like and subscribe.